only a few weeks into January, and the global M&A market is showing signs of life again. On Monday, Duke Energy announced the first mega deal of the year. It will buy Progress Energy for $13 billion in stock. Just last year, there were fewer than 20 deals valued at more than $10 billion. So how robust will 2011 be? Let's ask the head of global M&A for Barclays, Paul Parker. Paul, congratulations on what was a very strong 2010. Barclays top 2 and M&A advisor for U.S. deals, I understand. I mean, what accounted for that move up in the league tables?
Well, we were number 2 in the U.S., as you mentioned, and number 5 globally, and I think it's been the sustainability of the franchise that we've had over decades now, plus the addition internationally of Europe and Asia for us, and really connecting all the dots globally. I mean, if you look at the big trends, and you mentioned what's driving the growth that we've already seen this year, it's international. 38% of all deals were emerging markets related last year out of a $2.8 trillion market. And 32% of all deals were cross-border, up from 26 just a year prior. So there is definitely a hunt on for international scope and scale and assets in the emerging markets. And obviously our franchise is well positioned for that.
So what do you see in this new year? Is the trend going to be more cross-border deals? And what is it that people are shopping around? Is it the buying of experience? Is it simply the buying of a footprint? What's attracting that global interest? Well,
in the developed economies, there's such anemic growth. It's growing, and that's been helpful, and we will see development there. And the deals that are getting done are for scope and scale, and so you're looking for synergies. In the emerging markets, it used to be just about production. And what's happened is people have recognized the true demographic shifts in the emerging markets, the rise of a very large middle class. And so in addition to production, people need intellectual property, routes to market, brand names. There's a lot that companies in the developed economies realize that they don't have currently. They are out of position, and I think that's why we're seeing a large move. Secondly, I would say natural resources is the largest point of that, and as India, China, Brazil, other related economies continue to develop, you're going to have a need for those raw natural resource inputs, and there is a big international hunt for those.
So we started off the new year, the first big one, first big deal is that Duke Energy deal, $13 billion. Are we going to see similar deals of a same dollar amount, and how significant will cash be in those transactions?
Well, as you pointed out, well, in the utility sector with Duke, and we had Northeastern last year, those deals are typically done stock for stock, but 65% of all deals last year were done with cash as consideration. If you look at cash and stocks mix, it really took it up to 75% of all consideration last year was cash. Low interest rates, huge amounts of cash on balance sheets. Right. There's a real need to use that cash because right now it's sitting there as an unproductive asset. It's 7% of all corporate assets. It is dilutive, and CEOs are going to put it to work or they're going to have to give it back.
So what does that mean for leverage buyouts? Are we going to see something bigger than $10 billion this year?
Oh, I think so. Last year, there was a constraint as most financial sponsors, private equity firms, chose to go it alone, write their own checks, and that really drove a lot of activity in the $1 to $5 billion range. But still, financial sponsors were about 15% of the entire M&A market. I think that's going to expand as leverage expands, as the rates continue to be very low. And we're starting to see situations where financial sponsors are working together again in what we call club deals, where it's 1 or 2 or maybe even 3 sponsors coming together to buy something. And that alone will push up the size of transactions. We're seeing them being worked on now in the $10 to $15 billion range. Whether they happen or not will remain to be seen, but we're seeing transactions being contemplated, which just a few months ago was not happening.
Paul, before the break, you were saying you do expect to see the return of $10 billion deals and bigger in this new year. Is there any sector where consolidation, where acquisitions just don't make sense right now?
Well, I have to say, we have seen the recovery in the M&A market be full-based, and it's very broad. I will say that natural resources has been the top dog this year. I'd expect that to continue. The sectors which have traditionally been in that position have been financial institutions and industrials. I expect them to rotate as to a greater percentage of the market. But truly, we are seeing whether it's telecom space, the consumer space, real estate, which is the fourth largest asset class, all of those have had a resurgence this past year. I'd expect that to continue. I think this particular 2010 period was a bit of an anomaly in terms of deal size. It literally went down in terms of $25 billion deals year over year. I expect those transactions to come back. There are a lot of large companies out there looking and thinking about partnering up this year, and that takes some planning and some work. Because of the scale of the M&A development in the emerging markets, they tend to be smaller companies there, you don't find many $25 billion companies. I think emerging markets will continue to be very strong, but we will see domestically and in the Eurozone larger companies moving this year.
So you've got this wall of cash, you've got cheap money funding acquisition. How long does it take to get a deal done, start to finish? Is it still a sort of cautious progress situation?
Well, we see many more deals break apart than we see get completed. So indeed, people are spending the time doing due diligence, working on social issues, working on really how you would integrate and bring in companies particularly when they're of scale. I think it can take anywhere from 2 to 6 months for that kind of courtship and work to be done. Internationally, that is a longer process. One of the derivative things that we're seeing are combinations of domestic companies where someone buys someone else because they have a large emerging markets footprint already. They're not going in and taking the risk of buying a company or moving into a country that they don't already know. They're buying a domestic company but happens to have a backwards way into an emerging markets platform. Again, assessing that takes quite a bit of time.
All right, Paul Parker, sounds like you'll be busy.
We will be. Thank you.
Thank you.